Market gaps are very common in Forex market. Sometimes they will appear at market open as untraded wicked prices or during an economic event. So what are these gaps? What are the different types of gaps that we have in the Forex market? And most importantly, how do we trade them? I'm Wanjiru Gishangi from Forex Exploit Trading Academy, and on this session, I'll be taking you through everything about gaps, from identification to the different types that we have and how to trade them. So let's get into it. To the members of the Exploit family, we appreciate your continued support. To help us grow, leave a comment on this video and also all the videos, letting us know of a topic you'd like to see next on the channel. To the new members, you're most welcome to the Exploit family. To grow with us, subscribe, click on the notification bell so that you're notified every time we have new content. And also leave a comment about this video and also about a future video you'd like us to add. We learn and grow together. So if this is your first time on my channel, stay organized. Remember to watch the videos from the very bottom. That way you get to understand what you're getting into, what Forex is all about, and how to do it the right way. For everybody in here, whether you're a beginner or an intermediate trader, pay attention to the market structure video, because this is the video that will make you a profitable trader. If you can do market analysis using market structure, then you're one step closer to being a consistently profitable trader. So everybody rush to this video and make sure that you make notes. Not only should you make notes, you should also back test.
So what are market gaps? Market gaps are what we call untraded prices. And how do they come about? They come about by a sudden price shooting either upward or downward. How this happens is sometimes if you're on a downtrend, you will find that your last candlestick was here, and then after some time or the next day you wake up and you find that the market has dropped down, but in here there is some void, there is some gap, nothing was happening here, there's no action here. That is what we call a gap. And it is also possible if you're on the buy, so maybe that was your last candlestick and you find there's another one up there, so there's this missing action. This missing action is what we call the market gaps. Now there are 4 types of market gaps, but before we get to the market gaps, I would want to mention something just in case there's a beginner in here. There's something I want to talk about. This is now the 4 cycles, or the 4 cycles in the market. So if you're a beginner or maybe you're still adding to your skill set, this is something that is important. Now on a textbook kind of flow, or basically what we call the ideal market. So the ideal market has 4 phases. So we have what we call accumulation. So the market is trapping on the downside. Then it breaks out from that trapping. So this is what we call the accumulation phase. Okay, we accumulate. Then now after the break, we're going to have what we call the bull run. The bull run is the buying cycle, and there can also be ranges here depending on your time frame. So we get that bull run, and then at the top here the market is going to have another phase. We call this the distribution phase. It's also going to do that. This is now the distribution phase. After the distribution phase, the market is going to break from it and now start the bear run, or what we call the bearish cycle. And then from there again it goes back or creates a new accumulation zone, accumulation phase. So this is textbook. When we talk about textbook, we basically mean this is the most ideal way of, or ideal picture of the market, where we accumulate. Then here we're going to have the bulls. So we can call this the bullish run. And then we get to the top, we're going to distribute. Distribution is just a phase before the bear run. So then here we're going to have the bearish run. or the bear run, and then we go back to accumulate again. Now, this is the most ideal. Sometimes this won't happen all the time. So we may have this, we may accumulate, then run, then now consolidate a little bit, then break out again, run, accumulate a little bit, run, then distribute and repeat the same in reverse. Okay, so this is textbook, but this is what you're going to see mostly. So now on these four, this is where you expect to have your gaps. Now let's talk about these gaps. What are these gaps? So I'm just gonna leave that there so that I don't have to do it again. So gap number one is what we call the common gap. What we call the common gap. Now the common gap is basically found in the consolidation. So it's found in a consolidation. Remember, we have two consolidations. We have the accumulation phase and we have the distribution phase. And in there, with the other structure that I drawn here, you saw all those consolidations in between, you can find a common gap. So what we're saying is something like this. So in here, you will find that we are accumulating. We are accumulating. Then there's this gap here. Maybe this is a candlestick, and then the market runs and gets another one up here. So this gap, the gap here is what we call common gap. So we're going to name it number one. The same thing here. We are accumulating, but there's this gap. There's the consolidation. We're in distribution phase. We're in phase four, phase three. Sorry. Then we have this consolidation. Then there's a gap. This gap here is what we call the common gap. So we can name it gap one. So that is gap number one that we call the common gap. It's very common in a consolidation. Any consolidating market, you can get a gap. Now, how does it help a trader? Because at the end of the day, you want to have this information so that you can use them to trade. So you need to know how does it help you as a trader. Now, a common gap will help you to know to prepare for a breakout. To prepare, or rather, it shows or appears when that consolidation is almost done. It also shows you the direction. Like, hey, it's like a wake up call. It's telling you like, hey, it's almost time. It's almost time. We're done. We're almost done with this consolidation. So prepare. So a common gap is a wake up call that the consolidation is almost done and you should prepare. And in which direction are you supposed to prepare? It's in the direction in which the gap has happened. Now you can use the gap as a support and resistance to have those sniper entries when that breakout happens. You know, on the consolidation, it's very easy to do the break and retest. So where do you think the market will retest? It will definitely retest on that gap. So once you have a gap, you can actually do your limit order or your stop there, because you know once there is a breakout, the market will retest that gap or try to fill it up or retest it, and you can have those sniper entries and then you can join the new run. All you have to do is be pretty sure that that is either an accumulative phase or a distributive phase. Do not take the consolidations on the run. They are usually those mini consolidations on the lower time frame on the run, within the trend. No, that is not a common gap. We'll talk about the other gaps in here. But for you to do those sniper peak entries, you need to either be on the accumulative phase or the distributive. The second one is what we call the breakaway gap. Now the breakaway gap is found after consolidation. So once the consolidation is done, you're done with the consolidation, you've left the consolidative phase, and now you're off to the bear run or the bull run. That's when you're going to get a breakaway gap. Now, how does a trader use a breakaway gap? Or how is it important? How is it relevant on your trading? Now, the breakaway gap is an extra confluence. We use it for extra confirmation, especially if you're a swing trader. Now, this should be your best friend, especially if you're a swing trader or you enjoy having those runs. You know, you enjoy having a trade flowing the whole trend from beginning to end, then your breakaway gap should be your friend. Why? Because the breakaway gap is a confirmation that, hey, guess what? We are done with the consolidation, and whichever breakout we've done is actually legit. It's a true run. So your breakaway is a confirmation or extra confluence to tell you that, hey, whichever direction we've taken, it's true or it's real. Therefore, you can flex your muscles. This is now where, if you're a swing trader, you're not scared of those lot sizes. You're not scared. And I'm not saying you should overtrade. No, I'm just saying you can actually flex your muscles depending on your account size, and you can actually do a very good run. So breakaway gap is a gap that gives you extra confidence that the run that's happening, whether it's bullish or bearish, is true. Therefore, you can join a swing at that point. Number three, the gap number three is what we call a continuation gap. I mentioned this on the support and resistance video. So we have a continuation gap. This is found in a trending market. It's found in a trending market. I mentioned this when we're talking about the support and resistance because this is one of the common gaps. I also mentioned it on the patterns. I think the chart patterns is still there. It's very, very common. Now, what's a continuation gap? A continuation gap is a gap that you find within the runs, within the cycles, within the trend, within the order flow, whichever name you want to use. It's within that trend. And what's the purpose of a continuation gap? It is a signal or it is a confirmation that the trend still has some more push, still has either two or one pushes to go before it runs out. Be very careful. A continuation gap should happen at the middle stage, of your trend. I'm yet to do a video showing the stages of a trend, but it's important that it should be at the middle, or it should be after already you've left the consolidation, you've had your confirmation with the breakaway. Now the next gap would be a continuation gap. Now a continuation gap is a good, or it's a friend to those people who missed the peak trades. You missed the peak trades given by the common gap. You missed the breakaway gap. You're still ish. You're not sure if the reversal was true or not. So you missed the breakaway gap. Now you have another third opportunity to join the same trend using the continuation gap, because it's a sure way to tell you like, hey, this trend is still okay. This trend is still running. So you have a chance to join. And now this is where you might find, or you may find gap here. So you have continuation gap. Continuation gap is at the middle of the run. And on the other end here, you're going to find it here. Okay, so that's a continuation gap. It's very, once you have a continuation gap, again, you can flex on your lot sizes. You can flex to join the trade. You can actually make up. And for people who use market structure to trade, the continuation gap will happen after the confirmed structure. I hope you've watched that video on institutional reversal. Very, very important. It's a very, very important video for reversal. Where is it? This video, how to spot the institutional market reversal patterns. Now you also need to master this so that you don't get caught on the other wrong side. So make sure that you master these institutional reversal patterns, because once you have a confirmed structure in there, is one pattern or one reversal pattern that we call confirmed market structure. Once you have a confirmed market structure, then you spot a continuation gap. That's Christmas. Okay, if you have confirmed market structure and you get a continuation gap, boom, that's Christmas for you. Therefore, you can flex those muscles and actually make up for what you had lost maybe or what you had used. Again, I'm not encouraging you to blow your account. I'm just giving you scenarios where you can maximize. When the market decides to bless you, make sure that you maximize it, because when it decides to hit you, it also does its maximum. So it's always good to prepare. So continuation gap will be at the middle of the range, and if you find it with a confirmed market structure, then it will give you the heaviest run. Why the confirmed market structure gives you the heaviest run. The same thing with the continuation gap, it will give you the heaviest. This is usually the heaviest run in the market after the continuation gap. Now let's get the fourth one. The fourth one is called exhaustion gap. Now the exhaustion gap is found at the end of the trend. You've had your continuation, you've had your heaviest run. Almost before you get to the consolidative phase, before you get back to the consolidative phase, there will be a gap here. On the other end, you've had your heaviest run. Remember, we said number 3 gives you the heaviest run. So down here, just before you get to the accumulative, not within the accumulative phase, no. Just before you get to the last run, on the last lap there, we have gap number 4. Now, gap number 4 is called the exhaustion gap. What's the purpose, or how does a trader use the exhaustion gap? Now, exhaustion gap is a warning. Exhaustion gap works as a warning. It's warning the traders, especially the dumb money. We say that they're dumb money. There are people who just want to join the market when it's already exhausted. I don't know whether you sit on your hands completely and only wait when there is trouble for you to make more trouble for your accounts. I don't know. But exhaustion gap should be your warning. It's there to show you that, hey, the next run is the final one. And the final wrap is usually not really big. I'm going to show you examples on actual charts. So once you have an exhaustion gap, do not flex those muscles. Do not. And if you have to flex those muscles short term, you cannot join the trend at this point and try to maybe to hold it for long. No, maybe you can hold it for a few days or maybe a few hours, depending on the time frame that you're on. If you're on a 4-hour time frame, maybe you can hold it for a week or maybe 3 days, but don't try to hold it for long, because this is a signal that, hey, we are almost now done with what we were doing before, and we're getting into a consolidative state. On the other side too, when you're on the bear run or the bearish side, it will show up before the market does its last lap back into the consolidation or accumulation phase. Now, once you have an exhaustion, you can actually take partials. If you've been holding your trades from maybe the breakaway, or maybe you had the sniper on the accumulative on the distribution part, maybe you can take partials after the exhaustion. But I still have those risk takers. I have those risk takers who get the exhaustion gap as a signal to actually push it all in, because now this is your last harvest. To say that is all nothing. That is still okay. All you have to do is make sure that you're not holding it for long. Because if you do, now you're going to get yourself stuck for a while. But if you can get it at optimal entry, you can get 50 or even 100 pips out of the exhaustion gap, and then you can sit on your hands for a while this is happening. The same side, the other side is still true. You can flex your muscles for the last 100 or 80 pips. Now sit on your hands as you wait for the impact. So I know people who trade gaps only. So if you want to be a gap trader, this is how to do it. You just have to, this is how you start. Let me guide you on how to start if you want to be a gap trader. One, you want to go to a higher time frame. Can be daily, can be 4 hour, or can be 1 hour. Let 1 hour be the lowest. Don't go beyond 1 hour. Then you're going to find a trend that may be starting. It's either on the accumulative phase or the distributive phase. You can do this for a whole month. You can backtest for a whole month. All that, see if whichever phases you're on. Then mark these gaps. Mark these gaps as you move on. Okay? Because you may not get an accumulative or consolidation phase today. Maybe the market is already on the run. But what you do, you can backtest. Start now with the run. Check if you're going to get a continuation, an exhaustion, then consolidation again. Now, when it's at the top, now try trading all the gaps as you move. Now, note they do not always give you the 4 gaps back to back. Sometimes they may not give you a breakaway gap. If they give you the common gap, you may not get the breakaway gap. You may just get maybe a range or a consolidation there, and then they give you the continuation gap, maybe a warning. This is very, very common. The exhaustion gap is very, very common. I don't know what they use it for, but mostly there will be this. 1 and 4 is very common. Very common in the market. The exhaustion and the common gap are very, very common. The continuation is common for the USD currencies and US taxes and the GBP CHF, and the CHF pairs. They usually do good continuation gaps. But again, backtest, pick the currencies you like most. If you want to just be a gap trader, it is a very, very stable way of trading. If you may, just this is how to find your favorite gaps and of course how to trade them. So now we're going to get to our charts. This is a consolidation phase at the top before the change. The consolidation before the change. So we have this gap here. See the market gaps down. And we are at the top, so we want to change. We are on the consolidation pushing down. So the market gaps here. Now this gap, the same way I've said, you can use it for sniper entries. So you see this push to the top. If you head your trend line to the top side, you can see that there is break and then gap. So what would you do? You knew that the market, you would know after you've watched this video and you've made your notes, you've had me say that after that break, you know that the market will come back to test on that gap. Therefore, where would you place your limit order or something there? Okay, because you're going to use your gap as a resistance. You're going to use your gap as a resistance. Now you can watch the support and resistance video for more details on how to trade gaps as resistance. And if you have your trade there, then you can have your entry. You can have your entry there. And so that's a sniper, and you hold all this, right? You're able to do this fair run. You hold all this comfortably, without fear of anything. Why? Because you got it from the consolidation, got your entry on retest, and boom. Okay, that's good money there, right? Another way of trading it is, don't trade it when it happens. Just make sure that you wait for the retest, or if it's not retested, it's gonna be stop hunted. Okay, there'll be a week up there. Okay, let's find another one. We also have this telling you that you almost, you're done with this phase. You're going to go lower. Then we have the exhaustion. So we've been selling. At the end, we have this gap, then the last push or the last bear push, and then from there we change. So when you're doing the institutional reversal patterns, make sure that you pay attention to any gap on that pattern. This is a reversal pattern, like that sharp sword. Okay, down, impassive down, impassive up. It's a double impassive move. So if you have a gap there, it's telling you we are almost done. And US30 is very naughty when it comes to gaps. So you can actually go to US30 and find you have all sorts of gaps. Continuation gaps. So we just continue. They are at the middle. So once we're in the middle, you know that any gap means we're pushing We continue in the cycle. So once then we have the breakaway, we're done. We're breaking off from there and pushing somewhere else. USD card also has this, but for USD cards they are very common on the daily. They are very common on the daily. So this actually should have been an exhaustion. This should have been an exhaustion, not a continuation. It's an exhaustion. Why I would pick it to be an exhaustion is because it's giving you the final run before we change. It's a final. We've been doing all this, but then it appears, and once it does, we have this reversal. We have this reversal, sharp up, sharp down, and we're done. There is no more buying at all, so this becomes an exhaustion type of gap. So guys, that will be it. Remember, these are the four types of gaps. What you do, you go to your charts, check them out, check what you can trade, and I am sure that if you just decide to trade gaps, you're gonna be amazing. Now, for people who still have requests, if you have a video request or you have something that you want to share, maybe feedback or something you want, you can always reach me out on Facebook for Forex Experts Online Academy. I'm also a writer, so I write about Forex. Therefore, you can get either of my books depending on your level of skill. You can pick either of the books. If you're just a beginner, this is the book to start. If you're a price action trader, I have something for you. If you're a BTMM trader, of course, these two books here should be your guide. If you're a volume trader or block trader like myself, this is your book. We call it 5. And of course, for the fundamental traders, I got you back. And if you're not on Facebook, you can also find us on LinkedIn, same name, Forex Experts on Academy. Find us there, and you can send us a message, or just send us a message and we'll comment or something. And be kind if you're on this channel to share the link to the channel with your trading community. Watch the other videos and of course subscribe. If you don't know a broker, if you're still struggling with the broker, I have the broker here. So you can always click here for your best broker with the best rates. Otherwise, until the next time, I'm Monjuru Shangi. I wish you the very best. You have a good one.